Good evening, everybody. I welcome you on behalf of ACCA and Scan Schools of Accountancy, Islamabad. I hope yesterday's session was fruitful for you guys as we discussed the exam technique, the pain points of the examiner while marking your examinations, the do's and the don'ts that we have to follow while doing the paper. Plus, the most important thing we discussed in the yesterday session was we need to know that we have to stop at some point where the time for that particular mark expires. We have to stop our pen, we have to stop typing when the time ends. We are not going to have any marks for the time spent on anything written extra since it is not desired. The other key to succeed in the examination, as we discussed yesterday, was to understand the requirement. Once we are able to understand the requirement, we are able to pitch the knowledge we have in a very professional manner to the marker of the examination. Further, it was advised further it was advised not to add calculations where they are not asked for, and not to add explanations where they are not asked for. You have to be very specific to the requirement. This was it from, these were the main things we discussed from the yesterday session. Other than that, we have covered different topics. We have also gone through the examiner comments of the past exam questions. I was requested by the student to go through the capital allowances, the basis periods. So today I have prepared some handouts for you in which we will be discussing capital allowances in not very much detail, but I will try to summarize it for you people so that you can actually get comfortable with the topic if you are not already. Plus, we will be discussing basis periods, as basic periods has always emerged as a topic that is giving you the challenge. And for this attempt, basis period along with trading losses uh, is very, very important and critical in the coming examination as far as the examiner comments and the past paper trends are concerned. You can see my screen. We have this thing, capital allowance written. What are capital allowances? Okay, again, I will be opening this question tab for me so that any questions that you ask, I can see them and I can respond them accordingly. I will be asking you questions, and I would really encourage you people to give me the answers of them so that it is a very good interactive session and we get the most out of it. What are capital allowances? Capital allowances are basically the depreciation calculated as per tax rules. We all know, we are all aware that this depreciation is based on the accounting techniques. The accounting techniques mainly concerning the depreciation policy, the depreciation method, and the depreciation rate. When when we talk about depreciation policy, it is the pattern we have selected for depreciation. For example, full in the year of acquisition and none in the year of disposal, or full in the year of disposal and none in the year of acquisition, or pro rata basis. This is the policy that is selected by the management. Likewise, the method, maybe straight line method, maybe reducing balance method, maybe sum of year digit method, any method that the management wishes to choose can choose. Plus the rate, the appropriate rate as sorted out by the management, maybe 10%, maybe 20%, maybe 30%, maybe 5%. as per their own policies and requirements. They may add, they may increase it, or they may decrease it, or they may do any a thing they wish with the rates. So all these things, they are calculating the figure of depreciation, can be manipulated by alteration of any of depreciation policy, depreciation method, or depreciation rate. It is very easy for the management to manipulate the figure of depreciation. And if depreciation figure is manipulated, we can easily overstate or expense and understate or income that is being used, that is going to be used for the calculation of taxes. Hence, we are not paying the tax that should have been paid actually. So HMRC has very clear instructions on it, that they are not going to allow any depreciation in P6 or F6 examination or in any tax scenario practically. But the depreciation expense is a legit expense for all the sole traders or the corporations. So you cannot simply say that the depreciation expense is not allowed and we are not going to entertain any depreciation. Here HMRC, here HMRC proposed the alternate to the depreciation as capital allowances. So the capital allowances are the depreciation calculated as per the tax rules. The principles on which the tax system in UK is based are the uniformity and equality. No one is going to cheat the tax rules, the tax laws. They're applicable on every person uniformly and equally. We cannot simply being good in accounting or being manipulative in accounting can restrict or income to reduce taxation. So I hope it is clear till now for you people. So the depreciation is an expense that is allowed by HMRC, and how it applies uniformly and equally. They have proposed certain ways to calculate depreciation, and certain ways are jotted down here. Number one is general pool. So any organization, any corporation, any sole trader working can have different class of assets. Maybe they have fixed plant and machinery, they have movable plant and machinery, they have intangibles, as we have discussed in the yesterday session, that a business was selling out two intangible assets. So the business may have the tangible assets, the business may have the intangible assets, the business may have fixed assets, the business may have the movable plant and machinery, or the business may have the cars or different class of assets, which will not be attracting same rules. They have different categories for different assets to place. So general pool by its name says that generally all the items can be clubbed here. It says that it is available on all items of plant and machinery. Apart from that, it is available on second-hand low emission cars and all the standard emission cars, available to all kind of businesses, that may be sole trader, that may be partnership, that may be cooperation. Any purchases by the business will be added in the general pool. If it is an ongoing business, we will have a balance brought forward. We will be adding all the purchases in that. If it is a new business, all the purchases will be added. All the disposals during the period, they will be deleted. They will be subtracted. That will be a better word to say. And we will have a closing balance of that pool. We will be applying writing down allowance at the rate of 18% on the closing balance of general pool. So every time when we apply 18% writing down allowance on the closing balance of general pool, the balance of the pool will reduce. The concept of pool says that when we club things in the pool, they lose their original identity. One very important thing for the P6 examination is disposal of assets and the gain arising on them. When we calculate the gain or the loss on the disposal of an asset, we compute two things. Number one is selling proceeds, number two is the tax written down value. So any asset that is being grouped in the pool will not have any individual tax written down value as it has been grouped in the pool. So I have mentioned here the balancing adjustment never arises on the pool because there is no tax written down value available of any asset that has been pooled. Further, when we dispose of assets out of general pool, we subtract the figure that is lower of actual sale proceeds and original cost. We do this because when we subtract it on being lower side, we have more balance or an extended balance, extended closing balance of the general pool. If we will subtract the figure higher off, we will end up on the balance being on the lower side. If we subtract the lower off figure, we will be ending up on the balance on the higher side. So they have tried to facilitate their taxpayer so that they could get the maximum out of it. Further, this is written that this will be time apportioned. Now, the concept of time apportionment here is different, totally entirely different from the concept of time apportionment in employment income. In employment income, we used to time apportion every single asset for the months we were facilitated with that assets with. But here we need to understand that if the business has the year ended 31st December 2021, it means that the accounts are prepared for 12 months. So when the accounts are prepared for 12 months, there will be no time apportionment. We don't require any time apportionment when the period is equal to 12 months or it says year ended. But when it says period ended, so the period ended is generally less than or more than 12 months. In this case, we have to time apportion. For instance, if it is a 6 months period ended, we will be applying WDA at the rate of 18% and we will be multiplying it by 6 by 12. So this is it for general pool. If there are any questions relating to general pool, you are more than welcome to ask me the questions. This was requested from 2 to 3 students that joined the webinar yesterday that they need to understand capital allowances. I hope general pool is clear. Next up, further, I need to explain one more thing with you people, that while appearing for ATX examination, you need to know that you won't get a full-fledged 10 to 12 to 15 marks question for capital allowances. This will be scattered with 4 marks, 3 marks, 5 marks, maybe 6 marks in corporation tax question, or maybe in income tax questions, or maybe in property business income in income tax questions. So you need to be very much cautious that the examiner might test you specifically with the treatment of a second hand low emission car, or maybe with the treatment of the assets qualifying for AIA. So you have to be very much clear about each and every item that is applicable in that particular scenario, so that you do not end up wasting time on calculating AIA when only WDA was expected. As we did the question yesterday, we were able to see that only structure and building allowance was referred, and there was some equipment on which AIA might have been applied. So if students would go and they will start making the formats and spending time for calculating all the capital allowances that we used to calculate in TX examination. That won't be a wiser approach. You should be very clear about each of the item that is present in capital allowance, and you should know how to apply the rates in a quick and efficient manner so that you could easily, for instance, if I say that if a planted machinery that was not treated, that the person does not wish to get treated in in general pool, he wants to treat it in AIA. So immediately you need to know that in general pool 18% is given, in AIA 100% is given. The additional capital allowance coming will be 100 minus 18 is equal to 82%. So you won't be doing calculation of 18% first, then 100% first, second, and you take out the difference. No, you won't be doing that. You will simply be multiplying the amount with 82%, and you will say this is the additional amount that the person will claim as capital allowance if the asset is opted to classify under AIA instead of general pool. I hope things are getting clear for you. And let me see the question section if any question is here. Ravi, no questions as yet? Okay, the next up is AIA, Annual Investment Allowance. Now, in P6, since most of the discussion is required, we need to add narrative. We Okay, I'm sorry. I clicked on the wrong tab. I wanted to click on the questions. What is the difference between the balancing charge and balancing allowance? Ravi, you have to wait for a while. It is coming in next 5 minutes. Okay. Okay, so what is the main purpose of annual investment allowance? Annual investment allowance is basically an allowance given to every business to encourage them to keep investing, to encourage them to keep investing in the economy so that the unemployment may be lower down, or maybe the distribution of wealth gets better and better. Since the corporations or the sole trader will be investing more and more, there will be more economic activity, and that will be helping the cause of HMRC. So annual investment allowance may be categorized as a bait to all the struggling businesses, that they will get this much amount, like 1 million limit every year, if they keep on doing their business. So AIA plays a very critical role, especially in corporation tax and income tax. It is the most favorite capital allowance for every individual taxpayer or the corporation they try to maximize their expense with. So annual investment allowance is available to all ongoing businesses, since they are giving it for the businesses to get motivated and keep on doing business. When the business is not ongoing, it is going to cease in any period. In that specific period, not it will not be available in the year of cessation. Plus, it is available on all types of plant and machinery, like every plant and machinery qualified for WA, but the main difference is the cars will not be qualifying here. No car can ever enter AIA. There are scenarios in exam where it says that your junior has prepared some notes for you that your manager is going to use in an upcoming meeting, in which I have seen that the student that trainee or junior has added cars in AIA. When you visit that, you see that this treatment has been done wrongly. So you revise those notes, and you just do it only for AIA. It is a 1 million limit that is available for the expense incurred by the business on plant and machinery every year for ongoing businesses. The amount that does not qualify for AIA qualifies for WDA at the rate of 18% or WDA at the rate of 6% in general pool or special rate pool. Look, if a business has invested more than 1 million in 1 year on a fixed plant and machinery or maybe movable plant and machinery, For instance, I say 1.2 million. So 1 million will be dealt in AIA. We will be getting an equivalent amount of 1 million as capital allowance, while the rest 200,000 will qualify for general pool, and you will be doing the calculation by multiplying it with 18% or 6% if it qualifies for special rate pool. No balancing adjustment again arises. It is an yearly expense being granted, so no balancing adjustment. And again, it is time apportioned. If it is not, if the period, again, I will refer to what I have written here. If it is year ended, that is 12 months, you don't apportion it. If it is period ended less than more or 12 less than more or more than 12 months, then you will time apportion it. Again, this is a very common mistake that students do in P6, as they do not revise the TX content. They simply forget it when to apportion and when not to apportion. I hope it is clear. First year allowance is available at the rate of 100% on low emission cars. They are going for the greener environment. They are encouraging people to go for the low emission cars, and low emission cars will qualify. Whatever you spend on a low emission car, if it is a first hand car, it will qualify 100% for the first year allowance. Short life asset: if an asset is intended to be disposed of within 8 years from the end of the accounting period in which it is purchased, it is called a short life asset. So if you plan to dispose of an asset within 8 years from the end of the period in which you purchased it, you will be clubbing it as a short life asset. If a short life asset is labeled as a short life asset, it can never be pooled. So a depooling election is made and it is shown in a separate column, or maybe it is dealt separately while making the calculation. WDA of at appropriate percentage will be given as if it was not a short life asset and was pooled. So if you were not if you are not intending it to dispose of within 8 years, you would have pooled it maybe in general pool, maybe in special rate pool. So the appropriate percentage of any pool would have been applied here. Further is the private use of assets. We know that in sole trader case. Okay, can anybody answer me that the private use of asset applies in corporation tax or not? No. Thank you, Fawad. Thank you, Ali. It does not apply because there is no private use in that. That's it. Thank you very much. Okay. So this is the main adjustment we do for the sole traders. Only the business portion qualify for the capital allowance. The most common example is motor car. Each such asset is shown in a separate column. It is dealt totally separately. You cannot pool it because it cannot actually lose its identity. Appropriate WDA will be given if they had no private use and not put in a separate column. This implicates that had it not been in private use, it would have been placed under special rate pool, maybe, or general pool. So the appropriate percentage of the pool will be utilized. 100% of the WDA will be deducted to calculate the old balance of the asset, while the business portion will be shifted to the total column. Since the asset will be depreciated 100%, all the depreciation of an year, we will be charging it. All the capital allowances for the year, we will be charging it, but we will be shifting, or we will be taking only the business percentage as a legit capital allowance expense. In case of disposal, the business percentage will be accounted for in the balancing adjustment. Ravi, I will be coming to the balancing adjustment uh, once I am done with this. Okay, special rate pool. What is special rate pool? Special rate pool is another pool like general pool which clubs integral feature of land and building, thermal insulation of building, cars with high emission and long life assets. For long life assets, we have two requirements that in a period of 12 months, 100,000 is spent or more than 100,000 is spent. Otherwise, other than that, its expected useful life is at least 25 years. Again, this 100,000 is for 12 months. If the period ended or the year ended, if it is period ended or year ended, we will be considering it for time apportionment if it is year ended, and if it is period ended, we will be time apportioning it, and if it is year ended, we won't be time apportioning it. Yes, and WDA at the rate of 6% will be used here, and balancing adjustment never arises. So when we talk about balancing adjustments, I missed out in writing it. I will be adding it and these notes will be shared again. What is balancing adjustment? When we dispose of an asset in accounting, the gain or loss occurs. Is it so, Ravi? So the gain of accounting or the loss of accounting, this is referred to as, if it is gain, we refer it as balancing charge. If it is loss, we refer it as balancing allowance. If it is gain, accounting gain, we say it balancing charge. Balancing charge implicates tax will be charged. If it's loss, it's balancing allowance. It says tax will be saved. So I have explained that while calculating the gain or loss, I mean the balancing charge or allowance, we require sale proceeds and tax written down value. If we are not provided with both of these, the sale proceeds or tax written down value, we cannot simply execute balancing adjustment. For balancing adjustment to arise, we require the tax written down value. Tax written down value is the cost, the historic cost we have been provided with in the examination, and the capital allowances, cost minus capital allowances till time. This is tax written down value. We will compare it, and if it is giving us gain, it will be the balancing charge. We will be paying tax on it, and if it is loss, we are going to say it balancing allowance, and we will be saving tax on it. And if the balancing adjustment is arising on a car with private use, if any asset with private use is disposed and balancing adjustment arises, we account for the business percentage only for capital allowances. Any questions? Okay, I have not made any WhatsApp group, Yasir, but I am leaving my WhatsApp number here. You can text me, and all the students who wish to make a group, we can make that group. What do you mean by the business percentage? Okay, I'm telling you. I am putting up an example. We have a question relating to this. We will be discussing that in detail once we go through the basis periods. We will be doing the question today for capital allowances and basis periods mainly, so that every difficulty in that is overcome by you. Okay, for Ravi, if I'm saying that if sale proceeds, if I have sale proceeds of an asset, maybe 10,000, and its tax written down value is 6,000, I will be getting a balancing charge of 4,000. Now it says this car is used in is used privately for 25% and for business 75%. So this balancing charge pertains to an asset that is used for business and for private purpose as well. So I will only be taking 75% of this balancing charge, or if it is balancing allowance, to my final capital allowance figure. Please note that if it is balancing charge, it will reduce the amount of expense, and if it is balancing allowance, it will increase the amount of the expense. I hope you are clear. Yes, Yasir, this will be provided later. For the students who have opted for that, I believe it will be provided to you later. Okay, if there are any questions till now, please feel free to ask. And I will be completing the capital allowances by moving on to hire purchase. What are the assets that we club under hire purchase, or what do we refer to when we say that this asset has been bought under hire purchase? Anyone from you people who wish to answer? So hire purchase assets are the assets we purchase by not paying their full price or by involving any mode of finance in that. When we opt for any mode of finance in that, there are finance charges. Okay, I will be asking you a certain questions that I believe you will be comfortable with answering me. When we hire purchase an asset, for example, the asset with original cost of 100,000, we go for a hire purchase agreement and it costs us 130,000. What is the difference between what we call this difference between 100,000 and 130,000? This 30,000 is mainly the cost of financing. Is it so? So what is the treatment of cost of financing in tax adjusted trading profit when we do that? Anyone from you people who wish to answer? What is the treatment of this cost of financing if the asset is used for the business purposes? Okay, nobody as yet. The cost of financing qualifies as a legit allowable expense if the asset finance is used purely for the business purposes. Had this asset been used for business purpose, whole of 30,000 cost of financing would be an allowed expenditure. This cost of financing maybe is for 5 years. This would have been divided by 5 years, and appropriate yearly cost would have been calculated. This is number one. But if this is an asset that is in private use and in business use, in this particular case only the business percentage of this cost of finance will be an allowed expense. Other than that, it will all be disallowed pertaining to the higher purchase agreement. The asset qualifies for not this 130, but qualifies for capital allowances on the amount of £100,000. So any cost of finance, we are not going to get any capital allowances on that cost of finance. That will be dealt in dealt under separate provisions that we have already studied in tax adjusted trading profits. If there are any issues in tax adjusted trading profit, you might drop any questions here and I will be very happy to answer that. If there are any questions, please, you have 2 to 3 minutes to type. If there are not, I will be moving to base experience. Okay, I believe all of the students here are clear, specifically Ravi, and there were some other students who were asking me to elaborate capital allowances. This was the quickest of it. Okay, one thing is left for AIA. AIA, in case of corporations, is divided. The AIA of 1 million is available to one group of company or a one enterprise. If there are associated companies, we divide it by the number of companies, or if there are related businesses, only one AIA will be available. For related businesses, no AIA will be available for separate business. Some business can AIA be prorated? Yes, I explained here, it is written, it is time apportioned or prorated if it is the period ended. If it is year ended, it is already 12 months, you are not going to prorated. But if it is less than 12 months, if you're computing it for example, in a case of corporation tax, where you had been given with a period of account of 16 or 18 months, and you broke it down for first 12 months and later 3 or 6 months, that 3 or 6 months period, AIA will be time apportioned or prorated, but for 12 months it won't be time apportioned or prorated. I hope you are clear. And for related businesses, only one AIA is available. The businesses try to attract this 1 million expense by showing that the businesses are different but operating from the same premises or doing the same activity. They market related, and only one AIA is available for that. I hope it is clear for you. Okay, moving on to the next one, that is basis periods. Very difficult topic being perceived, as the students were mentioning in the yesterday session for questions. Okay, so what is the main difficulty being faced by you people while attempting the questions of basis period? Have you tried to do any questions? I have shared my WhatsApp number. For those who have been asking, you can simply drop me a text, and if I am able to make a group, I will make that group. And if you have any queries, any problems, any questions, even after we end up with this seminar or webinar, I will always be there to support the students. Okay, so now considering there are no more questions for capital allowances, we have moved to basis periods. And in basis periods, uh, we will quickly be summarizing the different rules in opening years and the closing years, so that we could do at least 12 at least 2 questions in today's session. You have been shared with those handouts in which I have added the screenshot of the questions, and I have tried to attempt the answers for you. Okay, moving on to basis period. The main objective of basis period is what? To align the tax year and the accounting period. When we start the trade, the basis period are made initially, falling in the opening year rules. But when we cease the trade, the business has to the business no more has to pay any taxes. Hence, the closing year rule apply, and the books of the business in HMRC closes. Basic steps you need to follow while attempting the basis period question. First of all, you need to know that when basis periods are required. You have gone through the topic choice of accounting date. We mentioned what is accounting date. Accounting date is the date on which the business prepares its accounts to. Like for example, if a person is preparing its account till 31st December 2021, then 31st December 2021 will be the accounting date. If a business chooses its accounting date as 6th April, the examiner often refers as tax year end. If accounting date is opted as 6th April, the 6th April tax year end is 5th April. If the counting date is opted as 5th April, no requirement. Why? Because it is already in line with the tax year. But if any other date is chosen, basis periods will be required. Any questions? Why we prepare basis period? We prepare basis periods only in the cases where the accounting date other than the tax year end has been chosen. It creates difficulty for both the business and HMRC to actually merge the accounts of the trader with HMRC. Hence, they require basis periods, which is a very effective tool in this case to match the accounting period and the tax year. What is the systematic approach? What are the steps that you need to do for attempting the questions of basis period? I was mentioning earlier, you have to do some steps. Number one step is find the date of start of business. Okay, then you have to find the first accounting date, and then you have to plot it on the straight line. In exam, if you don't have time to plot it on the straight line and you don't have any available paper, you might skip it. But if you have a paper, you can for your own convenience, you can draw a straight line, and you have to plot the dates on that straight line. And you have to find two things. Number one is the number of tax years in the first accounting period and the duration of that tax year. So from date of start of business to its first accounting date, we will get what I have explained you in the previous session, that both of these make first accounting period. So if I assume a question for you people, let me put this up for you. Give me a second. For example, it says if a trader started trade on 1st July 2016 and prepared its accounts till 31st December 2017, earning profits equal to 18,000. This is a scenario given. So the examiner may ask you to prepare basis periods slash basis of assessment slash assessable profits. All of these three terms mean the same. You have to prepare basis periods. The basis periods are prepared in the standard format. You may all are well known to it. You have to find the tax year, you have to find the basis periods, and you have to find the profits. First of all, this is the problem. This is the question. So if we see that it is 1st July 2016 and the accounts are prepared till 31st December 2017. The first accounting period is from 1st July 2016 till 31st December 2017. So any of you who could plot it on the straight line and can tell how many tax year are being involved in this question, in this first accounting period. Okay, 2016 and 2016-17 and 2017-18, two tax years. Ehtisham and Ravi, very good, very good. Thank you so much. So if I have calculated the tax year right, so first tax year I say is, as you people answered, is 16-17 and 17-18. Okay, if the first year I get right, that is 2016/2017. So if we get to it rightly, we won't be ending up in any mess, because we will be adding up 1 1 1, the next will be 17 18, the other will be 18 19, and so on and so forth. It will go on. So you have to identify the first tax year correctly. Once it is identified, it will be very easy for you to move on. Okay, so I requested you that you have to find two things: number of tax years, and the other thing was duration. You people answered there are two tax years, and the number of duration, because it is from July 16 December 17, 6 months of 16 and 12 months of 17, making up how many months? 18 months in total. So I have tried to make some rules for you. It says if there are two tax years in first accounting period and its duration is longer than 12 months. See, it is more than 12 months. So what we will be doing it, applying first year rule. That is, we will do date of start of business to first tax year end, that is 5th April. So in this case, if I do that, what is the date of start of business for me? It is 1st July 2017. And what is the coming tax year end? Can anyone tell me? Sorry, it is 16, and it will be going to 5th April in the coming year, that is 2017. So we have collected how many months here? 6 months of 16 and 3 months of 17. We will be ignoring 5 days of April that are being used here. And what will be the profits? Can anyone tell me? 18,000 is for 18 months, and here we are using 9 months. The profits will be 9,000. Any problem in the first year rule? Ravi, it's not 31st March. It should be 5th April 2017. You cannot write 31st March. It is not recommended at all. Any problem in the calculation of profits? It was very simple. 18,000 for 18 months. So there are 9 months involved. We will be dividing it by 18 and multiplying it by 9. We will be getting this 9,000 in the result. But the objective was to match the tax year and the accounting date. The accounting date is still 31st December, while the tax year date is the 5th April. We have not yet matched it. But it says once you have applied the first year rule, you have to move 12 months back from the ending date of the first accounting period. Okay, and this will be achieving the objective. What will be the next tax year? 2017/2018. And if we move 12 months back from the ending date of the first accounting period, the first accounting period ends on 31st December 17. So it will be coming back to 1st January 17 to 31st December 17. Exactly 12 months. Per month profits were 1,000, and we have taken 12 months, so we will be having 12,000 per month. So now this is 31st December. Now you could see that 31st December here as your accounting date, 31st December here as the basis period or the tax year. So the objective here is achieved, and the objective of basis period we have achieved. Hence the tax year and the accounting date has been matched. Now the business will do on the business will be preparing their accounts as per their accounting date, and their accounting dates has been merged in the date merged with the tax year in the register of tax. So once the objective is achieved, you apply ongoing year rules if there is any data available. For example, it says that in the next year they earned 12,000 profits. The probable answer will be 1st January 2018. It will be moving to the December 19. Now it will December 18. It will be moving smoothly until and unless if you change the accounting date or if you close the business. Now, one point is very important, as we discussed in the previous question in the previous session as well. When you have opted this date, now the actual profits of these 12 months was 18,000, but here you have paid 21,000. So 21,000 minus 18,000 is equal to 3,000. This is the overlap profits that you are paying for not opting 6th April, for not opting 5th April as your tax year date. 3 months overlapping here are in tax year 16-17, you move till 5th April 2017. But for achieving your objective, came back to 17 months, January 17, February 17, and March 17. 3 months, each month yielding profit of 1,000 are being overlapped, and the overlap profits in total are 3,000. Any problem still here, please? The first case is being concluded. How did we get 21,000? Okay, I explained, Evelyn, but I will do it again for you. Look, when we make the basis period for tax year 2016 and 2017, the basis periods will be made from 1st July to 5th April 2017 using 9 months, and year and per month profit here is 1,000. So 9 months, 9,000 profit. But when we want, when we want to achieve our objective, but when we in line or accounting date with the tax date, the accounting date was 31st December, and we were here at 5th April. We want it to be 31st December so that the objective of basis period applies. We moved 12 months back from the ending date of the accounting period that is already given to you. While we moved back, we came back again on 1st January 17. In 16-17, we moved till 5th April 2017. This implicates that 3 months of 2017 has already been taxed in tax year 2016 and 17 for this particular individual. But when you did this step, you again came back to 1st January 17. 1st January 17, February 17, March 17, they have been taxed in tax year 16-17 and 17-18 as well. So the overall profits that were actually 18,000 are now 21,000. 12,000 plus 9,000, they are 21,000, and 3,000 being overlap profits. This is the cost paid, or maybe this will be the cost to the business for not picking up or choosing the tax year end as its accounting date. I hope, Evelyn, it is clear for you. If it is clear, I can move forward. Please, can you please answer? I'm sorry. You're more than welcome. I am happy that it is clear for you. Okay, so this was the case where there were 2 tax years and the duration was more than 12 months. The question can bring up different 5 cases for you. We have done with the first scenario. Now I will be taking you quickly through the second scenario, and if you wish to solve, if you want me to solve a question with each of it, I can solve the questions that I have from the kit. Only the extract in which tax year the overlap profit will arise. Ihtisham, you can clearly see that 2017 and 18 you will be paying tax again. So the overlap profits are arising in the month of January, February, and March 17. So 17-18 will be paying again taxes on the months that have already been taxed in 16-17. I hope it's clear. Okay, an example would be good. Okay, Ravi. So we will have the 5, 6, 7 questions explained with the basis periods. I hope nobody minds. Guys, let me know when you want to take the break, as I really don't want that you end up not understanding anything from this webinar being arranged by ACCA for your convenience. Okay, the next thing we have is if there are two tax years in first accounting period and its duration is equal to 12 months. I take a question, I take a random question for you people, and let's see uh, how can we resolve it. I'll be very happy if you people provide me the input by answering the question. So I say the trader starts to trade on, for example, 1st July 2016. Accounting date picked is 30th June 2017 with profits equal to 12,000. Now you could see that I explained that we just need to have two things to correctly sort out the question. Number one was the date of start of business. The number two was the accounting date. So we have again the similar format to do the question. I will copy it so that I don't have to do the effort again. So can anyone tell me what will be the first tax year in this case? Can anyone tell me what will be the first tax year in this case? It should be the same as the previous example. Ravi? 1st July to 5th April. Fawad Ahmed. Yes, very good, Fawad. Thank you so much for answering me. The first tax year will be 2016, 2017. And in this case, it is very simple and very similar to the case we discussed. There are two tax years in this, right? If you could see, there are two tax years and the duration is exactly equal to 12 months. 1st July 16, 30th June 17. So when it is the case, in previous case, it was two tax years, but the duration was more than 12 months. Now, we have two tax years in the first accounting period, but its duration is equal to 12 months. In this case, in every case, the first year rule remains the same. And what is the first year rule as explained by Fawad? It is 1st July 2016 till 5th April 2017. Ravi, I would encourage you if you could tell me the profits involved in this case. The profits for 12 months was 12,000. Here we are taking again 9 months. So 9,000 will be the profit. The next will be 2016, 2017. And here the basis period will be 1st July 2016 till 30th June 2017. See what I did? And the profits will be how much? How much profit will be here? Anyone from you? 12K. Okay. There is some problem with the question. We need to have the next period. The next period is, yes, it is equal to 12,000. Very right. Very right. 12,000. We are exactly taking the period as it was given in the question. So 12,000 will be the profits. Now you could see 30th June in our tax working as basis periods and 30th June in the question, they both are the same. and the objective is achieved. Once the objective is achieved, we apply ongoing year rules. Ongoing year rules or current year rules, they say whatever your accounting period is or your period of account is will be your basis period, as it has been matched on the base somewhere previously. So apply first year rule, that is date of start of business to 1st 5th April coming tax year end. Move 12 months back from the ending date of the first accounting period, that is 30th June was the ending date of the first accounting period. We moved 12 months back from it and the objective was achieved, and we will be applying ongoing year rules. Okay. Evelyn, if you are with me, I would request you to please calculate overlap profits for me in this case. Are you there? Okay, Fawad, you were quick enough, but I would urge Evelyn to please calculate. Okay, so the actual profits were 19. How come? No, it's not like that. Okay, let me explain. The total profits for the period were 12,000. Okay, but when you applied the basis period, what you did in tax year 2016, you moved from 1st July 16 to 5th April 2017. The objective was not met, yet you had to move on to the other rule. When you applied this other rule, by the application of the other rule, you reached 1st July 2016. So the whole period taxed in 2016 2017 is re-taxed in tax year 2017-2018. So all the profits that you were taxed at in 2016-17 are being taxed again in 17-18. So the total profits being taxed are 9 plus 12, 20, 1000 minus 12,000, that is 9,000. Okay. Okay, Evelyn, I got it. I hope all of you are pretty much clear with this. Okay, bingo. Now, let's move on to, this was pretty much the similar case. So you have now in your data bank, if there are two tax years and the period is longer than 12 months, or if there are two tax years and the period is equal to 12 months, you will be doing the same treatment. Agreed? Now, what is the next thing we have? Now we have discussed two tax years. There might be one tax year featuring in the question. Okay, let me put up another question that is available in the book, but I will write it for you so that you don't have to go somewhere else. You keep your concentration here. A trader starts to trade on 1st June 2015 and prepares accounts till accounting date, that is 31st December 2015, having profits equal to 12,000. 12,000 is for the reference. Okay, now this is the question. It says calculate the assessable profits. So what we will be doing here? Can anyone tell me how many tax years are involved in this case? You have to simply plot it in on a straight line, and you have to assess it for the number of tax years. Okay, Ravi, it is one tax year. Okay, great, one tax year. And which will be the tax year? Can anyone please specify which tax year here will it be? Since the trader has started on 1st June 2015. Ihtisham, it is 15-16, very rightly said. If the date of start of business is prior to 6th April, then If it is 2014, then we will be using 6 April 2014, right? But if it is after the tax year end, we will be using it accordingly. So here, the trader started to trade on 1st June 2015. In 2015, 6 April would have arrived earlier. So this would have been starting from 6 April 15. So the tax year will be 2015 and 2016. And what will be the basis period here? No matter what case is, the first year rule remains the same. If you are unable to detect, anything, you should know how to apply the first year rule. And first year rule is very simple. Can anyone please tell? It is the date of start of business, that is 1st June 2015 to coming 5th April. When the coming 5th April will be coming? 5th April 2016. Okay, we need to have another period for this, and that period is 1st June 2016 till 31st it is 1st December, so it will be 1st Jan, 31st December 2016, having the profits of 24,000. Okay, now when we have engaged for fulfilling our first year rule, when we reached at 5th April 2016, we have borrowed some months of the second accounting period. You have seen that the first accounting period ended on 31st December 2015. So all the profits of 20 till 20 December 2015, they are 12,000. They will be featuring here. Plus, there are some months of the second accounting period. So the second accounting period starts at 1st January, and we have prepared this basis period till 5th April. So January, February, March, we will be taking it from the second accounting period. Okay, and 24,000 is the profit for 12 months. Yes, 18,000. Okay, 24,000 is the profit for the 12 months. What we will be doing is dividing it by 12. Per month profits will be 2,000, and we have taken 3 months here, so the total will be 18,000. Any problems till now? I hope there are not any. Okay, but the objective is still not achieved, and we have already taken the second accounting period into consideration. Now what will we be doing? The next tax year will be 2016, 2017. Now whenever it is the case that you have single tax year involved, and you have to achieve your objective, you will be preparing your second basis period on the date. Okay, you will be preparing your second basis period ending on the ending date of second accounting period. So the ending date of the second accounting period, here I am highlighting it, it is 31st December 2016. So the next basis period here will be 1st Jan 2016 till 31st December 2016. Now you have seen that or months 31st December is matched, and the objective here is achieved. Now it comes to the overlap profits. Per month profit were 2,000. Here we have replicated the same, so 24,000 will be the profits here. What will be the overlap profits here? We have moved till 5th April 2016, and when we went back to January 16, February 16, and March 16 are taxed again 2016 and 2017. So the overlap profits here will be 12,000 as mentioned. Okay, Evelyn, now I believe that you are pretty much good with this. I'm sorry. So I have written the narrations here for you people. Ravi, no, it can't be 6,000. How? Okay. No, no, no. It should be 6,000. You are right. Per month profit is, okay, guys, you have to concentrate. See, when you come from 1st June 2015 till 5th April 2016, and when you go back to January 16, there are three months, January, February, and March. Okay. Per month profit is 2,000. For 6 months, for 3 months, it will be 6,000. Very good, Ravi. You are right. Fawad and Evelyn, you better gear up for the next question. These are not the right answers. Can you people please tell me how you figured out 12,000? I am amazed. Okay, when there is single tax year, what you will do is you will apply first year rule, and that will include second accounting period. Then you will be moving 12 months back from the ending date of the second accounting period, as it has been mentioned. This will achieve your objective, and then you will be applying ongoing year rules. That is, you don't have to worry for making any other basis periods. You will simply be using please explain again. Okay, Fawad, I will be explaining it again for you. Look, how 6,000. 1st June 2015 till 5th April 2016. Okay, and when you do it here, 31st December 16 say to 1st January 2016, when you go, January 16, February 16, and March 16, they have been taxed twice. Other than that, there are no months being taxed already in 2015 and 16. Per month profit is 2,000. So this will, when we multiply 2,000 with 3 months, it will be 6,000. I hope now it's clear for you. There are only 3 months. 2,000 is the profit for every month. Okay, now we have the next case up. It says if there are two tax years in the first accounting period and its duration is less than 12 months, then what will we doing? Okay, let me find a question and write it down for you. Okay, I got this question. Start of trade on 1st Jan 2015 till 30th September 2015, and the profits were 18,000. The next period it says is 1st October 2015 till 30th September 2016. The profits are 24,000, and the next period is 1st October 2016 to 30th September 2017, yielding the profits of 12,000. Okay. So now this is the question, and I would urge again, if you could see, the first accounting period is from 1st January 2015 till 31st September 2015. Now, How many tax years in this? Can anyone? Okay. Anyone? Okay, Evelyn, two. And which of these tax years, can you name them, please? 14, 15, rightly said. And what is the other one? Okay, Zubair, thank you very much. 14, 15, 15, 16. Very good, very good. Now I feel like you are getting it right for you people. Okay, that's great. So what will be the first thing we will, what first thing we'll be doing here? We will be applying first year rule, and first year rule says that you have to move from the date of start of business. What is the date of start of business? 1st Jan 15 till the coming 5th April or the tax year end. So 5th, so then what will be the 5th April? When the 5th April will be coming? It will be coming on 5th April 2016. Now, the profits for the 9 months, January 15 till 30th September, there are 9 months. Profit is 18,000. Per month profit will be 2,000. Okay, Fawad, get it? 2,000 will be per month profit. And here, how many months we have taken? January 15 till go forward from the start date. Okay, so where you are getting a little quick. That's nice. Okay, let me just wipe this out so that there is no confusion. Okay, 1st January 15 till 5th April 2016. So we will be using whole of our first accounting period, 18,000 profits will be featuring here. Yes, yes, it's 5th April 2015. Yes, you're right, you're right. Okay, 1st January 15 till 5th April 2015, coming year end is 5th April 2015. We are taking 3 months. Per month profit is 2,000. 3 months profit will be 6,000. Now, if we move 12 months back from the ending date of the first accounting period, we will be ending up on a date where the business was not there. The business was not existing, so we cannot do that. Or if we end up, if we move 12 months back from the ending date of the second accounting period, that is 30th September 2016, we will be ending on a date which is not already taxed. There will be some months that will not be, that will not have been taxed. So HMRC would never allow us to move 12 months back from the ending date of the second accounting period, or move 12 months back from the ending date of the first accounting period. So in this case, we are bound to move 12 months from the date of start of business, 1st January 2015 till 31st December 2015. Now, what we have done is, we have used this whole period, plus we have used some months of the second accounting period. Second accounting period was equal to 12 months, having 24,000 profits. How many months we have taken? It ended on 31st September, the first accounting period, and we have taken 3 months from the second accounting period. So 6,000 in total, it will be 24,000. Okay, 6 by 12, if very good. Okay, so everyone clear till 24,000? I move forward. See, the objective is still not achieved. This is 31st December and we are preparing our accounts till 30th September. Now, what we will be doing is, the next tax year will be 18, 19. Yes. So we have already used some months of the second accounting period. Now we will be moving we will be moving 12 months back from the ending date of the second accounting period, which will bring me on 1st October 2015 till 30th September 2016. Any problems? This is exactly the same as our second accounting period. Hence, the profits will be the same. I will move it down so that you could see the screen. Okay, it is 24,000. Any problems till now? Okay, yes. It's not just the second accounting period, it's third as well. I've done it. Okay, any problems till 24,000? I hope there are not. Great. So 30th September or accounting date and the basis period, they have been matched. Once it is matched, we will be applying ongoing year rules, and that is the accounting period will be the basis period, and this is how it will be done. So what will be the overlap profits? Can anyone calculate it for me? I believe when we move from 1st January 15 till 5th April 2015, and in the second accounting period from December 25 till 1st January 2015, January, February and March, they are overlapping. Then the overlapping will be some months here as well. October 15 till December 15, there will also be the overlapping period, which will be yielding in total of 12,000 overlap profits. Yes, there are total 6 months, and the overall overlap profits will be 12,000. The easiest way to calculate the overlap profit is, if the period is not asked for, you have to just calculate 18,000 plus 24,000 plus 12,000. This will be the total, and you have to subtract it with the amounts you have paid here: 6,000, 24,000 and 24,000. So the difference is 12,000, and this is your overlap profit. So I have written some narrations for you. You have to apply the first year rule, then you move 12 months forward from the date of start of business, including second accounting period. Some months of second accounting period will be used here, and then you will be moving 12 months back from the ending date of the accounting period. The objective will be achieved, and we will be applying ongoing year rules or current year rules moving forward. Any problems till now? Okay, so sir, in second basis period, I think the basis period start from 6th April. No, Fawad, it is not like that. Look, Fawad, you have to understand that you are talking about something in which there are 3 tax years. Here, there are not 3 tax years. It is very simply explained that there are 2 tax years in the first accounting period, and as you could see in this question, 1st January 15 till 30th September 2015, there are. Oh, Bilal. Okay, I just forgot the break. Okay, I'm sorry. I'm sorry. Let's have a break. The session is going without break till now. Okay, we are going to have a break of 15 to 20 minutes, and we will be back around 10:15 or 10:20. Thank you. Everyone back? Let's wait for another 2 minutes for everyone to join, and we will start. We will be starting with our next case at 10:20. Okay, guys. I guess we had enough break. So, Fawad, I hope. Okay, I think Fawad has left. No worries at all. Okay, so we have the next question for the basis period. Where there will be 3 tax years in the first accounting period. Let's find out a question for this. I will be writing it down for you guys. Start of trade is on 1st Jan 2015, and the first accounting date the business has chosen is 30th June 2016, having profits of 18,000. The next period is 1st July 2016 till 30th June 2017, yielding a profit of 12,000. Okay. So guys, this is the question where the trader has started to trade on 1st January 2015, and he has ended its accounts on 30th June 2016. The resultant profits are 18,000. Now, if we have to sort this question out, if we have to sort this question out, what will be our approach? Again, we will be dissecting this first accounting period. We will be dissecting this first accounting period to ascertain as how many tax years are in the first accounting period, as to ascertain how many tax years are in the first accounting period and how long is its duration. So can anybody please tell if you have calculated the number of tax years in this scenario? The period is from 1st January 15 till 30th June 16. Fawad, okay, you have joined back. This is, there are 3 tax years in this case, and in the case where there are 3 tax years, in any case, as I've explained, what we will be doing in the first year rule is date of start of business till 5th April, first tax year end coming our way 5th April 15. Okay, so the total number of months here is 2015 Jan till December, 12 months. June 2016, Jan till June 2016, 6 months. Overall 18 months. 18,000 divided by 18 per month, profit will be 1,000. Per month profit will be 1,000. We have taken 3 months here, so the resultant profits will be 3,000. And the first tax year, can anyone tell me the first tax year that would be applicable in this case? Since it is starting on 1st January 2015, before 5th April 2015, so this will be starting from 6th April 1415. Okay, Ehtisham Fawad rightly said. What will be the next tax year? 2015, 2016, and now we have 3 tax years. There is no limitation if we go from 12 months back from 30th June 2016, we will be arriving at 1st July 2015. In the previous basis period, we have only taxed till 5th April 15. So if we reach at July 15, April, May, June, they are the months that will not be taxed. So we have to be very cautious that we are not going to move 12 months back from the ending date of the first accounting period. Instead, there is a complete tax year lapsing in between this accounting period. So here we will be taking that particular tax year that has been lapsing in complete manner. So it will be 6th April 2015 till 5th April 2016. Now, exactly 12 months from this 18-month period, the profit will be per month is 12,000, per month is 1,000. For 12 months, it will be 12,000. And the next is, but still the objective is not achieved. The accounting date was 30th. The accounting date was 30th June, but we are still moving with 5th April. Hence, no objective has been achieved till now. So the next will be 2016 till 2017. Now, if I move 12 months back from 30th June 16, 30th June 16, I will be reaching at 1st July 15. Okay, 1st July 15 till 30th June 16. Again, when I reached at 5th April 2016, I have not yet exhausted the first accounting period fully. So when the first accounting period is not exhausted completely, I cannot use the second accounting period for any work around. In the previous cases where we used second accounting period for the achievement of the objective, we already used some months of the second accounting period. Here, there is no second accounting period involved till now. In fact, the first accounting period is not fully utilized. So we have moved 12 months back from the ending date of first accounting period, that is 30th June 2016, to 1st July 15. And again, this is from the period where per month profit is 12,000. Here for 12 months, it will be 12,000. Any problems till now? Now you have seen that this has been achieving our objective. 30th June, the objective achieved. Now we will be applying ongoing year rules. What ongoing year rules say? The accounting period, as stated above, is the basis period. So it will be, I will copy it from here. And I'll just change the date, the year 16, and this is 17. And the resultant profits will be 12,000. Can anybody tell me how many, how much will be the overlap profits in this case? Okay, Fawad. Etisham, how come 9,000? Do we have Evelyn? Okay. Jawad Khan says it will be 8,000. Okay, guys. I will be explaining again how to calculate overlap profits. As in P6, you won't be getting a bigger question, a question having more marks. It will be maximum 5 marks or 7 marks or 10 marks, not more than that. And it might ask you to calculate overlap profits in a given scenario for 3 marks or 2 marks, and they are very easy marks. Please look at the basis periods again. When you come from 1st January 15 till 5th April 15, there are no overlap profits, okay? Since this is the first tax year. Now, okay, Fawad, you have changed from 7,000 to 9,000. Okay, we will be explaining it now. When you ended first tax year at 5th April 15, you move to 6th April 15 till 5th April 16. There are no overlap profits till now. There are no overlap profits till now. But for the achievement of objective, when you moved back 12 months from 30th June, you arrived at 1st July 15. So 1st July 15 was already taxed in tax year 15, in tax year 15, 16. Now see that this is 1st July. I am highlighting it for you. I'm bolding it. And this is 5th April 16. So this is the period. This is the period 1st July 15 till 5th April 16. That will be the overlap area. So the overlap profits here will be 9,000. And I have told you the easiest way to do it. You have calculated the total profit. Actual profits are 30,000. And when you have done this, it are 12, 12, 24, 36, and 3, 39. 39, you are paying taxes on 39,000, while the actual profits were 30,000. So this will be 9,000 of or overlap profits. Are we clear on this now? Etisham, you were right. Okay. So you apply first year rule, then the tax year lapsing between will, as it is, be the basis period. Then you will be moving 12 months back from the ending date of the first accounting period. Your objective will be achieved here. and then the applying of ongoing year rules or current year rules will be done, and we will be moving along till there is any change of accounting date or the closure of business. Now, we have done all 5 cases of the opening year rules, and I would request you to mention the topics that you want me to cover in the coming session. There are 2 questions that I have selected. The 2 questions from the kit, one is from the March attempt and one is from the previous attempt. I have shared it with you in the handout. I don't think so that we will have time to do those questions today, but we will be starting off with those questions tomorrow in tomorrow's session. And apart from that, any topics you want me, annual allowance charge and remittance based charge. Okay, Ravi? Okay. I have noted. This is. I will. In fact, I will bring out some question that covers it, and I will also explain. Other than that, you are more than welcome to drop all those topics that you want me to cover. The basic idea of this webinar is the attendees should be getting comfortable for the examination. It says practice to pass. So as we have practiced 5 questions for 5 different rules of basis period, and I believe you will be having much ease to conclude it. You will be telling me the topics that I need to cover for the rest of the 3 sessions, and I will be doing that for you. Yes, we will be doing. I have selected 2 past exam questions. We will be addressing them. Okay, we will be doing that. We have done some portion of that in the previous session, and we will be doing some that in further questions coming in further sessions. Okay. Anyways, you have to drop by all the recommendations, and I will be covering them hopefully. Okay. Now the closing year rules. I have discussed it in the previous session. The link is shared in the questions, and you can get it from there. Otherwise, if we by luck get a question in which the professional marks are appearing, I will be throwing light on them again, how to achieve the maximum out of those easy professional marks and the ethics area, because they are the easiest marks to get. Okay, now coming back to our basis period, the basic periods are not complete till we. Okay, bad. Okay. The basis periods are not complete until and unless we understand the closing year rules. We have mentioned that when a business starts to trade, or when a trader starts to trade, it has to pay tax. And for the payment of tax, it has to align itself with the dates of the tax. And when the trader is ceasing its trade, there is cessation of his working in the tax books as well. The tax authorities, HMRC, will how do we get the recording of the first webinar? It is shared by the presenter in the questions earlier, but I will make sure that I also get it and share with you so that you can view it again as per your convenience. Okay, so the HMRC has to close your accounts in its books, and they have opted closing year rules depending the situation in which you are closing your business. You have to note that a business never closes when it is in normal circumstances or making profits or does not have any survival issues. The business closes in some uncertain or an unwanted scenario happens. And we have seen in previous questions of basis period that a business opts for an accounting date and it carries on with that accounting date till any problem occurs or the closure of business or the change of accounting date occurs. So that normal accounting date is followed again and again, year by year, without any change. But when the business ceases, there are fair chances that the business cessation does not follow your normal accounting date. For instance, if I write a case for you, for instance, a business was preparing its accounts from 1st January 2019 till 31st December 2019. So this is the normal accounting date that the business has been following. Now see, if there is something uncertain happens, if there is anything uncertain happen, the next period that we have will start on its normal date, that is 21st January 2020. But something happened, some problem occurred, some machinery faulted, or any other thing happened, and the business has to shut it down on 30th June 2020. See, the business is not following its normal accounting date. The business is not following its normal accounting date. The business has ceased on an accounting date that is different from its normal accounting date. So when the closing year rules we are concluding, you have to keep a very close eye on the ending date, that is the cessation date of the business, and the ending date of the second last accounting period. So I have written it for you that you have to concentrate on the ending date of the last and second last accounting period. If they both are following in the same tax year, then combine both the periods. Okay, for instance, I say the profits in this case were 12,000 and the loss in this case I say 6,000. Now, this is the case. Can anybody tell me the last and the second last accounting date is following within the same tax year or different tax year? How come? Are you being able to hear me? Okay, so if you could see, okay, in this particular case, the second last accounting period, the second last accounting date is in the tax year, that is, if anybody could tell, it's 1920, while this falls in 2021. So it is a clear case of both following in a different tax year. When they both fall in the different tax year, you simply have to do nothing but this accounting period becomes your basis period. I hope it is clear for you. This accounting period becomes your basis period when the second last accounting date and the last accounting date falls in a different tax year. Now you have to ensure one more thing. The overlap profits that occurred uh, while preparing the opening year rules, they have to be adjusted somewhere, and they are adjusted when we prepare the closing year rules. So if we assume that the overlap profits in this case were 5,000 Okay, let them be 9,000. What would have we done? So this is the loss, maybe it's profit. Okay, we do it as profit. So these are the overlap profits of 9,000. This is our last tax year 2021 with these dates. This is the 6,000. The original profit, overlap profits are 9,000. 6,000 will be adjusted here. So the rule of thumb for overlap profits in closing year rule is that you deduct or you set it off with the profits of the last tax year. There were 9,000 in total, 6,000 were adjusted here. No payment to be made on the profits here since it is zero. Remaining with 3,000, they will be adjusted from the previous tax year and you will be paying taxes equivalent to on the amount equivalent to 9,000. So this is the closing year rule where both the dates fall in different tax year. I hope you are clear. It is written over here, if ending date of the last ending date of the last accounting period and second last accounting period, how many years can you carry back to the overlap profits? There is no particular restriction on that. You can carry them back until you get them sorted. If they are in tax year, if they're in the same tax year, then you have to combine both the periods in different tax year, not in the same tax year or different tax year. The accounting period will be the basis period. Rules for overlap profit: first last tax year, then second last tax year, third last tax year, until you get all the overlap profits sorted. Okay guys, I'm giving you a little 2 minutes to consolidate. If there is any problem, you can please ask me. Sheikh Salman, video of the first day recording is being shared in the question box. It will be answered against your question again. This is a question. For the second, can you please 6,000 minus 6,000? Okay. There is no big deal in that, Jawad. I just said that you had overlap profits of 9,000. The profit for this period was 6,000. So I'm adjusting the overlap profits first in the last tax year. So 6,000 minus 6,000 was zero. The remaining overlap profits I was left with was 3,000 and they were adjusted in the previous or the second last tax year. Now we have a question that the trader was working and its normal accounting period was from 1st July 2018 till 30th June 2019, and something happened and the business closed at 31st December 2020. So can anybody tell if they both fall within the same tax year, both the dates, that is the last accounting period, the ending date of the last accounting period and the ending date of the second last accounting period, are they falling in the same tax year or a different tax year? There is always a difficulty in sorting this kind of scenario out to write which is the tax year and which is not. Can anybody please? Okay, Evelyn, and which is what is it in the different tax year? Look again. I've just changed the date. 30th June 2019, 31st December 2019. Now same tax year. Yes, different tax year has been sorted out. Now we are going to look at, and which is what is the tax year? Now they both are falling within the same tax year. In this case, we combine both the periods. When we combine both the periods, we take the starting date of this month of the second last accounting period, and we take the ending date of the last accounting period. So we will be taking 1st July 2018 till 31st December 2019. Again, if we are given with overlap profits of, for example, 20,000, then how they will be treated? This is the last tax year here. The periods are combined, so the profits are combined. Total profits combined are 18,000, and the overlap profits here are 20,000. So 18,000 will be treated with 18,000, and we will be left with 2,000 of untreated overlap profits. Carried back to second last tax year, and the tax year rightly mentioned is 1920. So this is the end of the basis period from my side. As I have explained, the 5 opening year rules plus 2 closing year rules, each one with the example and the calculation of overlap profits. I will be focusing on this particular point, that you need to be very much clear about which rule you pick and how do you apply that. The first year rule remains the same in every case of opening year rules. The second year rule gets different depending upon the number of tax years and duration of the first accounting period. The trick is to draw a straight line and determine your tax year, determine the tax number of tax years and the duration, and you will be comfortably sorting out your question. And there would not be the longer questions expected from this area, but we have witnessed many small parts equal to marks of 5, 6, 7 in different scenarios. They are oftenly examined. So we will be moving to our exam question now. If there is anything else that is to be covered from income tax, you can drop it in the question bar. The Thursday and the Friday session will be mainly based upon corporation tax, capital gains tax, and inheritance tax, and some elements of value added tax. I will be trying to cover the questions of income tax and some aspects of value added tax in tomorrow's session, so that what we have learned, we could cover what is the sequence of opening year draws. Can you please elaborate your question, Zubair, so that I can be on point answering it? Okay, when it comes to losses, I need to, okay, okay, okay. So when we talk about trading losses, in our previous session, when I was focusing on time management, I specifically talked about the scenarios of trading losses. The trading losses is pretty straightforward for you guys, as you have done extensive practice in TX examination, and in ATX, the application is the difference. Rest, the calculation of the loss remains the same as was done in TX. So if I quickly summarize trading losses, there were options of carry forward, there were option of setting off in current year and previous year. There were option of treating losses in opening years, as I believe Zubair asked, and there was a terminal loss relief. So the carry forward option was was quite an easy option, that it was available automatically for indefinite number of years to treat or losses, and it was available for ongoing businesses in every case. If the second pattern or the third pattern, the losses are not treated fully in this, you have always option to carry forward the trading losses under carry forward option. This is the simplest and this is the most applicable method that you can apply every single time. Once after treating through any other section or through any other method, the losses are not treated fully. So the difficult one is this setting in current year and previous year and the losses in opening years. The examiner always asks you to utilize losses that maximizes the relief for the taxpayer. So for maximizing the relief for the taxpayer, you have to try different combinations of treatment or settlement of the losses. This might be time taking, time consuming for you, as you see that different sequence could bring a different answer, and then you try another sequence and it brings you a different answer. So you have to be very much clear about how to structure and when to attempt such kind of questions. My recommendation would be that trading loss question should be attempted at the last, because it usually takes more time than expected. Now I go to setting off in the current year and previous year. In this case, we are setting off it against total income after deductible interest. So we set it off against total income after deductible interest with two tax years. Which one of tax year of loss or previous tax year? In isolation or in combination, in any sequence. So for instance, if I say that my tax year of loss is 2019/2020. What are the options available under setting off in current year and previous year? I have four options available. Can anyone answer how many options available, and which one which and what are those options? Okay, so it says tax year of loss only. So it can be 2019, 2020, or 2018, 2019, or 2019/20 and 2018/19, or 2018/19 and 2019/20. Now you could see that we have four options that we have to try, and while addressing that part of requirement, that the setting that brings up the maximum advantage for the taxpayer, we could see there are different four options, and we have to try each one of them. The practice you have done would enable you to pick the right mix depending upon the understanding of the scenario you have with yourself. So these are the four options that you will be using, and when you use this, one important thing is the personal allowance is wasted. You have to set off the maximum possible amount of loss. No restriction of loss is allowed, or the book says no partial claims allowed. I hope, are they not the same periods? No, they're not the same periods. See, Ravi, the tax year of loss is 2019/2020. So under this heading, under this treatment of loss, you have four options that you can use your loss against the total income for 2019 only, 2019/2020 only, 2018/2019 only. There are different tax years. There are different sequences involved. I am telling you, I will be explaining this, how they are different. Now, we say that the personal allowance has to be wasted because you have to set off the maximum possible amount of loss. Now, you could see among these four options, I will be trying to see what I am seeking for. Am I seeking for cash flow benefit or preservation of personal allowance? I'm taking these two examples. So if you are looking for cash flow benefit, then you would be trying to set it off in the current year so that you don't have to pay extra taxes, or you could save that amount that you could have blocked by paying the cash for the amount of tax. This is number one. Or if the preference is to preserve the personal allowance, you will be trying to set off your loss against the year where maximum amount of loss is covered, but without wasting your personal allowance. So you have these considerations side by side going with you. So you have to pick the option that is not wasting personal allowance and giving you cash flow benefit. That will be the best suited option, and you just cannot uh, reach to the best mix without practicing these questions. So you have to practice the trading losses, and you will be getting to know the right mix. And still there are chances that you don't end up initially on the very first instance at the right mix. So you might have to try 2 to 3 sequences. That is why it is recommended that you go for the trading loss question at the end of the exam, as it might take more time than you have allocated. Okay, now as Zubair was asking me the question about the losses in opening year of loss, basically it is something very extraordinary done by HMRC to facilitate the taxpayers. Why? It says, what is loss in opening years of trade? If there is loss in first 4 years of trade, we categorize it as opening year loss. So if there is loss in any of the first 4 years of trade, you can carry it back in previous 3 years. You can carry it back in previous 3 years and set it off against total income. So if I say you have incurred loss in 2019, 2020, and your business started in 2018 and 2019, and you made a loss in 2019, 2020. So you have made the loss in the second year of your trade. This is the tax year of loss for you. You can carry back this loss in previous 3 years against the total income of these. So in 1819, if you were trading and there was some trading income, there was some property business income, if there was some interest income or any other income, you could have set it off against that. But if you go beyond 1819, for instance, you go I take an example of 1718. There was no trade existing in 1718, but the HMRC is facilitating the taxpayers. Okay, the trade was not existing at that time, but you might have been employed. You might have been earning some. Uh, you might have been earning from your saving income, might be from other from other non-saving incomes like property business income, like some pensions or any other source of income. So you can write off your trading losses against the income that is not your trading income. Even when there was no trade, the income you earned can be used to settle the trading loss, only in the case if the loss arise in first 4 years of trade. Yes, yes, Zubair. So if there is any problem till now in losses, you can ask me. I will be trying to cover a question of terminal loss relief in tomorrow's session. It is a little crucial to attempt. So first 4 years of trade can be carried back. No, Ravi, you have to understand this, uh, that any loss occurring in first 4 years. So I said the business started to trade in 2018-19. Okay, so 18-19, 19-20, 2021, 2022. These are the first 4 years of trading. Any year making the loss can be carried back to 3 years. Set off against capital gain is allowed. Yes, definitely it is allowed if you are writing it off, if you are setting it off in this very context. Current year and previous year total income. No, no partial. Okay, The rule of thumb is when you are writing it off against total income, the partial claims are never allowed. You have to set off the maximum possible amount, no matter your annual, your personal allowances wasted. This is why the examiner asks you to set losses in such a way, to set off losses in such a way that is most beneficial to the taxpayer. So you have to preserve your personal allowance, you have to see for your cash flow benefits and other objectives at hand. Okay, you have the handouts, and we have this question. Okay, if there is any other question, students, yes. And if still there is anything pending, you can always go for the carry forward if the business is ongoing. Any further questions? Okay, guys, this question is from March 2020 attempt. So this question is from March 2020 attempt, and we will not be able to solve it in today's class, but what we can do is we can try to finish reading it so that we have a clear idea how to attempt a question, how to read it, how to understand the requirements. So I would urge you to start reading. If it is not clear, please tell so that I could zoom it a little more. Okay. So first of all, you have to read the introductory paragraph. First of all, you have to read the introductory paragraph, and then you could go to the requirement section. So in this question, this is Thomas. Thomas required advice on tax implications of commencing to trade, the choice of accounting date for his business, and whether or not to register voluntarily for value-added tax purposes. Eins, his wife requires advice on the tax implication of selling share in respect of which relief has been obtained under EIS scheme. Carry forward against trading income, not total income. Okay, so this is a classic question where you have been asked for your advice involving the choice of accounting date, voluntarily registering for value added tax, and some advice in respect of enterprise investment scheme. If I go to the requirement part, somehow the requirement is clear in this introductory paragraph. Thomas details are: Thomas is UK resident and domiciled, uses his capital gain tax annual exempt amount every year, so no wastage being done. he's utilizing. So it implicates that his gains are equal to his annual exemptions or maybe more than his annual exemptions. Receive dividends of 2000 every year. So when you see the dividends of 2000 every year, the nil rate band for dividend clicks in your mind, and you have to highlight it from my side in your mind or on your paper, that you do not forget nil rate band application while attempting the question. This is a very important tip, that while moving on with the question, you somehow forget to highlight the critical smaller parts. And while attempting the question, you may apply irrelevant rates on these 2000. You have to be very much cautious that you apply the right rate, that is the nil rate on this dividend. Okay, now Thomas, sale of sporting memorabilia. Thomas started selling items of supporting equipment from his collection during tax year 1819. So HMRC agreed that these sales should be subject to CGT in the tax year 2019. So they are subject to CGT. In April 2019, Thomas started purchasing and selling more items of sporting equipment, such that HMRC have said that he will be regarded as trading from 6 April 2019. So here one implication is very important. If Thomas asks you for advice for the business asset relief, you have to be very much sure that the business asset relief can only be obtained from 6th April 2019 onwards, when he was considered trading. The reliefs on the trading assets, the relief on the assets involved in trade, are given once you are in trade. Before 6 April 2019, you are not referred to do the trade, so there will be no reliefs available if it is asked in the later stage of the question, which I believe it is not asked. I'm just mentioning you just to approach the question here. I hope there is no question in the question box. Can't access the recording, please. Okay, Abim Bola Dada, we will try to share the link again after testing it, and I will make sure that you get the link that is accessible and up and running for you to access the recording. Okay, Thomas expected trading result from the sale of sporting equipment. Okay, no, we left the question here. Thomas will not be required to register for value added tax for the foreseeable future. It means that they are giving you details that you are not exceeding the minimum threshold to register for value added tax. So if you want to register, you are going to voluntarily register. That is mentioned already in the opening paragraph of the question. Thomas will, however, consider registering voluntarily for VAT if financially beneficial for him to do so. So you are going to register for VAT. The biggest consideration here is, are you dealing with the people who are VAT registered or not? Because the impact will be on the recovery of the input VAT. If you are trading with the VAT registered persons, then only you could recover your input VAT. Other than that, it will be very difficult and it won't yield any benefit financially. Okay, Thomas expected trading results from the sale of sporting equipment. Thomas is considering either a 31st March or 30th April year end for his business. Now you could see there are two accounting days involved in this question. Thomas estimates that his total income less expenditure for 12 months ending 31st March 2020 will be 11,500. So he's telling you that the overall income he will be having for the 12 months after deducting the relevant expenditure is 11,500. In this case, they are not providing the details of the expenditure. Each item of equipment is purchased and sold for no more than 1,000. all the costs he incurs are deductible for tax purposes, so you don't need to worry about recalculating. I mentioned that the detail given in the question is not to be re-verified, or the calculation should not be done again and again, as it is clearly mentioned in the exam paper. All of the costs are tax deductible. Thomas expects his profits to increase steadily after 1st April 2020. So the profits are expected to increase in future. Eins, UK resident and UK domicile is a high rate taxpayer, has made will make disposals for CGT purposes other than described below, and which are, what are them? Okay, we will be ending our session after reading the whole question. We will be doing its solution in tomorrow's session, and I have noted what areas you want me to cover tomorrow, but I urge everybody of you to please again tell me which areas you want me to focus on in tomorrow's session after we conclude these two questions that I have selected today. Okay, Eins is going to sell. Eins sold a painting on 1st July 2017 for proceeds of 196,000. The sale gave rise to a gain of 86,000. Again, the gain has been calculated. You don't need to look for the cost. You don't need to look for other information. Since the gain has been calculated, the examiner is not interested to ask you for the calculation. He is interested in something else. You have to find that in the requirement. If you miss out on that, you are not serving the purpose of the examiner. Eins acquisition of shares in Tavira Limited. Eins subscribed for 72,000. Eins subscribed 72,000 pounds for 20,000 shares in T Limited on October 8, 2017. These shares are qualifying enterprise scheme EIS. Somebody asked me about this. We will be discussing it in detail in tomorrow's session. I selected to defer the maximum possible amount of the gain and sale of the painting against the acquisition of the shares. Obtained EIS relief of 18,600 against her income tax liability for tax year 17-18. Intends to sell all the shares for 95,000 on 1st June 2020. If undertaken, this sale would qualify for entrepreneur relief, so attracting the tax rate of 10%. So we have this question that we have read. We will be reading its other part. I guess I have missed out some part of it. I will be finding it out and will be sharing it again with you, and we will be doing the solution of this question tomorrow. You have these handouts. You could go through the solution I have prepared for you, and we will be practicing at least 3 questions tomorrow with the elaboration of the topic you say. So guys, I would request if you could type the topics again for me that you want me to cover tomorrow. Okay, Ravi, your topics are noted. Anyone else? Okay, if we quickly go through the VAT, okay, we will do tomorrow. Okay, okay. Okay, guys, thank you very much for your patience and your time. And we will be conducting our session tomorrow. Thank you very much. Your questions are welcome. You have my email, you have my number. Any questions, any recommendations you want, you can always send them to me. Thank you very much.